What if you could invest in ETFs that don't just match the market but crush it, turning a modest portfolio into life-changing wealth faster than you thought possible? Forget settling for the S&P 500 steady climb. Today, I'm unveiling 5 ETFs that have outpaced benchmarks like VOO and SPMO, delivering jaw-dropping returns of 16 to 30% annually. In this 30-minute video, I'll dive into SCHG, SMH, AOTG, QQQM, and CHAT, high-growth funds packed with powerhouse names like NVIDIA, Apple, and Google. These aren't just alternatives to VOO's predictable 14% or SPMO's stellar 19%. They're game-changers that could supercharge your portfolio for 2026 and beyond. Stick around for performance breakdowns, risks, and tips to build a wealth-building machine. Let's dive in. Why look beyond VOO and SPMO? VOO, the Vanguard S&P 500 ETF, is a cornerstone for long-term investors, boasting 14% annualized returns over the past decade per Vanguard, a 1.3% dividend yield, and exposure to 500 companies, safe, diversified, and endorsed by Warren Buffett. SPMO, Invesco's S&P 500 Momentum ETF, kicks it up a notch with a 5-star Morningstar rating, 19% 5-year returns, and 30% over 3 years, crushing VOO by focusing on high-momentum stocks like NVIDIA and Meta. But what if you want even higher returns or a different growth angle? A financial enthusiast scoured the market for 5 ETFs, SCHG, SMH, AOTG, QQM, and CHAT, that either beat SPMO's 19% or complement VOO's stability, offering explosive growth for those willing to embrace higher risk. Let's explore why these funds could make you rich the fastest. ETF #1, SCHG Charles Schwab, U.S. Large Cap Growth ETF Overview. SCHG, the Charles Schwab U.S. Large Cap Growth ETF, targets high-quality large cap growth stocks, companies like NVIDIA, Apple, and Microsoft that grow revenues and earnings faster than the market. With 200 holdings, SCHG diversifies across technology, 45%, communication services, 15%, consumer discretionary, 12%, healthcare, 10%, and financials, 8%, balancing growth and stability. Its focus on fast-growing giants makes it a direct competitor to SPMO's momentum strategy. Key metrics: dividend yield, 0.37%, $3.70 on $1,000, paid quarterly, low as growth firms reinvest profits. Expense ratio, 0.04%, matching VOO's ultra-low cost and beating SPMO's 0.13%. Performance, 16% annualized return over 5 years, 17% over 10 years per Schwab, slightly trailing SPMO's 19% but beating VOO's 14%. In 2025, SCHG gained 18% versus VOO's 7.85%. Volatility, 18%, equal to SPMO, higher than VOO's 15%. Why it's a winner. SCHG's focus on growth leaders delivered 18% in 2025, driven by tech giants like NVIDIA, 120% gain per Yahoo Finance, and Broadcom, 60%. Its 200-stock portfolio reduces risk compared to SPMO's 150, yet matches its 18% volatility. A $10,000 investment in SCHG grew to $21,600 in 5 years, versus $24,900 for SPMO and $19,600 for VOO. Its 0.04% expense ratio maximizes returns, $40/year on $100,000 versus SPMO's $130. For 2026, analysts project 10 to 15% tech growth per Morgan Stanley, pushing SCHG to 15 to 18% returns, though a 10 to 15% correction per Goldman Sachs could cut gains to 5 to 8%. SCHG complements VOO for stability or SPMO for momentum, ideal for long-term wealth. ETF #2, SMH, VanEck Semiconductor, ETF Overview. SMH, the VanEck Semiconductor ETF, holds a 5-star Morningstar rating and invests in 26 semiconductor giants, NVIDIA, TSMC, Broadcom, ASML, Intel, and Applied Materials, that design and manufacture chips for cars, smartphones, and AI. Unlike SCHG's broad growth focus, SMH's concentrated portfolio bets on one sector, sacrificing diversification for explosive returns. Key metrics: dividend yield, 0.33%, $3.30 on $1,000, paid annually. Expense ratio, 0.35%, higher than SCHG's 0.04%, but competitive for sector funds. Performance, 30% annualized return over 10 years, 28% in 2025, per VanEck, crushing SPMO's 19% and VOO's 14%. Outperformed VOO by 20% in 2025's tech rally. Volatility, 25%, higher than SCHG's 18% due to sector concentration. Why? It's a winner. SMH's laser focus on semiconductors fueled 30% annual returns, driven by NVIDIA's 120% and Broadcom's 60% gains in 2025. A $10,000 investment grew to $37,500 in 10 years versus $24,900 for SPMO and $19,600 for VOO. Its 25% volatility reflects sector swings. SMH fell 15% in April 2025's 20% market dip, but recovered to new highs by September. For 2026, AI and chip demand, 20% growth per Bloomberg, could drive 25 to 30% returns, but a 15% correction risks a 20% drop. SMH's 0.35% expense ratio, $350 on $100,000, is reasonable for its performance. It pairs with VOO for diversification or SCHG for growth amplification. ETF #3, AOTG AOT Growth and Innovation. ETF Overview. AOTG. The AOT Growth and Innovation ETF is an actively managed fund targeting 48 high-growth, high-margin companies with low marginal costs. Think NVIDIA, Toast, AMD, Robinhood, TSMC, and Google. It aims to beat VOO and SPMO by focusing on innovative firms with strong earnings and revenue growth, blending tech and fintech. Key metrics: dividend yield, 0% as profits fuel growth. Expense ratio, 0.75%, high due to active management. Performance, 30% annualized return over 3 years, 20% in 2025, per AOT, beating SPMO's 19% and VOO's 7.85%. Outperformed SPMO by 1% in the last 6 months. Volatility, 22%, higher than SCHG's 18%, reflecting active bets. Why it's a winner? AOTG's 30% 3-year returns come from picks like NVIDIA, 120%, and Toast, 50% in 2025 per Yahoo Finance. Its 48 holdings balance risk better than SMH's 26, yet its active strategy outperforms SCHG's passive approach. A $10,000 investment grew to $21,900 in 3 years versus $17,200 for VOO. In 2025's tech rally, AOTG gained 20%, beating VOO's 7.85%. Its 0.75% expense ratio, $750 on $100,000, is steep but justified by outperformance. For 2026, 15% tech growth could push AOTG to 20 to 25% returns, though a 15% correction risks a 15% drop. Pair with VOO for stability or QQQI for income. ETF #4, QQQM Invesco, Nasdaq 100 ETF Overview. QQQM, the Invesco Nasdaq 100 ETF, mistakenly called QM in the transcript, tracks the Nasdaq 100, investing in 100 tech-heavy giants like NVIDIA, Google, and Microsoft. It's a passive, low-cost alternative to AOTG, offering broad exposure to growth and innovation. Key metrics: dividend yield, 0.7%, $7 on $1,000, paid quarterly. Expense ratio, 0.15%, lower than AOTG's 0.75%. Performance, 20% annualized return over 5 years, 18% in 2025, per Invesco, beating VOO's 14% but trailing SPMO's 19%. Outperformed VOO by 10% in 2025. Volatility, 20% between SCHG's 18% and SMH's 25%. Why it's a winner. QQQM's 100 stock portfolio, weighted toward tech, 50%, delivers 20% 5-year returns, driven by NVIDIA, 120%, and Microsoft, 30%. A $10,000 investment grew to $24,900 versus $19,600 for VOO. Its 0.15% expense ratio, $150 on $100,000, beats AOTG's 0.75%, and its 0.7% yield adds income. In April 2025's dip, QQQM fell 12%, but recovered 15% by September. For 2026, 10 to 15% NASDAQ growth, per Morgan Stanley, could yield 15 to 20% returns, with a 10% correction risking an 8% drop. QQQM balances SMH's concentration and AOTG's cost, complementing VOO. ETF #5. Chat, Roundhill Generative AI and Technology ETF Overview. Chat, the Roundhill Generative AI and Technology ETF, invests in 42 AI and tech innovators like NVIDIA, Google, Palantir, Microsoft, Oracle, and Meta. Its active management targets the fastest-growing AI firms, aiming to capitalize on the AI boom. Key metrics: dividend yield, 0%, as AI firms reinvest profits. Expense ratio, 0.75%, matching AOTG's active cost. Performance, 25% return in 2025, per Roundhill, crushing SPMO's 19% and VOO's 7.85%. Outperformed both by 10% in the last year. Volatility, 23%, slightly above QQQM's 20%. Why it's a winner. Chat's AI focus delivered 25% in 2025, fueled by NVIDIA, 120%, and Palantir, 80%. A $10,000 investment grew to $12,500 in 1 year versus $10,785 for VOO. Its 42 holdings balance risk better than SMH's 26, and active picks outperform QQQM's passive approach. In 2025's rally, Chat gained 25% versus SPMO's 19%. For 2026, AI's 20% growth, per Bloomberg, could push Chat to 20 to 25% returns, though a 15% correction risks a 15% drop. Its 0.75% expense ratio is steep but warranted by AI's upside. Pair with VOO for stability or SCHG for growth. Comparing to VOO and SPMO VOO, 14% 10-year return, 1.3% yield, 0.03% expense ratio, 15% volatility. Safe but trails growth ETFs. SPMO, 19% 5-year return, 0.54% yield, 0.13% expense ratio, 18% volatility. Strong momentum but outpaced by SMH and AOTG. SCHG, 17% 10-year return, 0.37% yield, 0.04% expense ratio, 18% volatility. Balances growth and cost, trailing SMH. SMH, 30% 10-year return, 0.33% yield, 0.35% expense ratio, 25% volatility. High risk, high reward for semiconductor bulls. AOTG, 30% 3-year return, 0% yield, 0.75% expense ratio, 22% volatility. Active growth, beating SPMO recently. QQQM, 20% 5-year return, 0.7% yield, 0.15% expense ratio, 20% volatility. Broad tech exposure, cost-effective. Chat, 25% 2025 return, 0% yield, 0.75% expense ratio, 23% volatility. AI-driven high upside. For 2026, SMH and AOTG could hit 20 to 30% returns if tech grows 15%, while SCHG and QQQM offer 15 to 20% with less risk. VOO's 8 to 10%, per JP Morgan, is safest. Building a wealth-building portfolio. For maximum wealth, diversify. 50 to 60%, VOO, $5,000. $6,000 in a $10,000 portfolio for 12% growth. $600, $720, 15% volatility, 20 to 30% SCHG or QQQM, $2,000, $3,000 for 15 to 20% growth, $300, $600, 10 to 15% SMH or chat, $1,000, $1,500 for 20 to 30% growth, $200, $450, 5 to 10% AOTG, $500, $1,000 for 20 to 25% growth, $100, $250, 5% QQQI, optional, $500 for 14% yield, $70, cushioning volatility. This yields $1,070, $2,090 annually, with 18 to 20% volatility, targeting 15 to 20% returns in 2026's 8 to 10% market, per JP Morgan. Risks and considerations for 2026 SCHG QQM. 10 to 15% correction risks, 8 to 10% losses, but diversified holdings recover fast. SMH, 25% volatility risks, 20% drops in a tech correction, 15% per city. AI chip demand mitigates downside. AOTG chat, high expense ratios, 0.75%, and 22 to 23% volatility risk, 15% losses. Active management may lag in flat markets. Market outlook, 10 to 15% tech growth, 8 to 10% S&P 500 growth, 10 to 15% corrections possible. Diversification across VOO, SCHG, and SMH mitigates risks, with QQQI's income cushioning dips. 3 non-financial advice tips for 2026. Anchor with VOO, 50 to 60% for 12% growth, $600, $720 on $5,000, $6,000, 0.03% expense ratio, 15% volatility. Blend growth ETFs, 20 to 30% SCHG QQQM, $300, $600, 10 to 15% SMH chat, $200, $450 for 15 to 30% returns. Cap high volatility funds at 15%. Invest consistently. Dollar cost average $50 100 weekly into VOO and SCHG to smooth dips. Reinvest dividends, $70 100/year for compounding. Why these ETFs could make you rich. In 2025, SMH's 28%, AOTG's 20%, QQQM's 18%, Chat's 25%, and SCHG's 18% crushed, VOO's 7.85%, and SPMO's 19%. A $10,000 portfolio split 50% via VO, $5,000, 20% SCHG, $2,000, 15% SMH, $1,500, 10% QQQM, $1,000, and 5% Chat, $500, grew to $11,800, $12,200, yielding $70 100. For 2026, 15% tech growth could drive 15 to 25% portfolio returns with VOO stabilizing volatility. These ETFs offer high-octane growth for long-term wealth. Track strategies on financial community tools in the description. If you love this, smash that like button. Our puppy mascot did. Subscribe for more ETF breakdowns and check out our last video on your screen. Keep crushing the market and take it easy. Peace. This video is for educational and informational purposes only. Investment performance is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult a qualified financial advisor before investing.